So in this video, I'm going to break down exactly what you can claim, what you can't claim, and some of the most important things that investors miss when actually working out the tax obligations on their property investments. Now, I'm not an accountant, so make sure that you do consult an accountant, and also make sure that you watch some other videos on how you can legally reduce your tax with self-managed super funds, and also some of the other benefits of reducing your capital gains tax. I'll produce another video on that. So let's get right into it. So what are the three types of property investment deductions? Well, number one, when you buy a property investment in Australia, deductions usually fall into one of these three categories. Right? Immediate or ongoing deductions, right? You've got depreciation deductions, and you've got costs that you can't claim now, but that can reduce your tax later. So we're going to cover all three in the next few minutes. Strategy number one is ongoing tax deductions. Now, these are expenses you can usually claim in the year in which they are incurred, as long as the property is available for rent during that time. So things are like interest on investment loans, loan account and bank fees, right? Mortgage broker fees. This is usually spread over 5 years, right? Now, important, loan principals repayments are not tax deductible, right? Only the interest portion will be tax deductible. So property running costs, that's another immediate deduction you can cost. Things like council rates, water rates, land tax, body corporate or strata fees, right? Property management fees, letting fees, right? Advertising fees, anything to do with renting the property is tax deductible in the year that it's incurred. And the third one is repairs and maintenance. So anything that breaks down, you can fix and tax deduct in the year in which it was actually repaired. Now, it's important to remember this does not include renovations. It's just repairs or replacements of things that have broken down in your investment property in that financial year. Critical distinctions are repairs, you can deduct immediately, but any improvements you have to actually depreciate over time. The third thing you can claim is insurance, landlord insurance, building insurance, contents insurance for rental items. So any type of insurance can be claimed in the year in which you've paid it. Now, the other thing is professional fees, things like accounting fees, right? Tax agents, quantity surveyor fees for the depreciation. They can also be tax deducted in the year in which you incur them. The second strategy is depreciation, which is basically your non-cash deduction. Now, depreciation is one of the most powerful benefits in property investing if it's done right, because it reduces the taxable income you're paying without costing you cash every single year. There's what we call capital works, which is division 43. Now, this applies to the building structure itself. So typically claimed at 2.5% per year. So you've got 40 years to depreciate the entire building, of the property. Now, applies to new builds, renovations and extensions, and structural improvements to your property. They'll all be depreciated over that 40-year period. Now, it's important to remember that some of the deductions you can do are much higher when you do a new build as opposed to buying an existing property, which is one of the biggest reasons why you should be investing oftentimes in a new property and building a property, because you've got to get the developer's margin and capital growth immediately as soon as it's completed. Plus, you're going to get the maximum tax deduction from that property. The key to remember is only do it with properties that are positive cash flow, geared, that give you positive income. Don't negative gear your properties to save on tax. That is a big mistake. Plant and equipment inside your property, things like air conditioners, hot water systems, oven, cooktops, carpets and blinds, light fittings, they're also depreciated, but it's a different schedule, so it'll depend on the item. So talk to your accountant, but they can usually be depreciated anywhere from 3 to 5, 7 years, right? You need to talk to your accountant to actually figure out what's the maximum or minimum period you can depreciate these items over. So they're separate from your actual building of the property itself. Now, it's important to remember that since 2017, right, second-hand buildings, you cannot depreciate the plant and equipment, but new builds you can. So that's why it's beneficial, as I said, to actually buy a new property or build a property, because you'll get the full tax depreciation as well as the capital gain increase once the property is finished and fully tenanted. Now, the third strategy is costs that you can't claim now, but you can actually claim later. Now, some of these costs aren't available to you immediately, but they will reduce the capital gains tax when you sell the property in the future. So things like stamp duty, right? Conveyancing and legal fees, buyer's agents fees, building and pest inspections, certain non-tax deductible holding costs, right? These can obviously all be used later on to reduce your capital gains tax when you sell that property. So make sure that, again, you talk to your accountant about what is actually allowed in this particular bucket of tax deductions. The most common non-tax deductible items that most people don't understand is loan principal repayments. You can't deduct those. Purchase price of the property, obviously. Initial repairs before the first tenants move in, they're not immediately tax deductible. Private or personal use expenses if you use the property for your own use. Travel to inspect residential properties are no longer tax deductible since about 2017. So claiming these incorrectly can cause you problems with ATO, so make sure that you actually talk to your accountant about maximizing those deductions as well. Now, the key things that most investors miss is the property must be available for rent. Deductions might be apportionate if rented part year, so if you're only renting it half the year, you can only get half the deductions. Record keeping is critical, right? Ownership structure matters, whether it's in your personal name, trust, self-managed super fund. I'll talk about it in another video, right? Fantastic way to invest in properties in your self-managed super fund, especially if it's new property. It can fast track your retirement. And I've invested in self-managed super fund properties and I'm paying zero tax on some of them. So fantastic way to actually get your, get your tax levels down. So just to summarize this whole thing for you, when you buy an investment property in Australia, you can usually deduct things like interest, running costs, right? Repairs, management fees, insurance, depreciations. Now, some of the costs that aren't deductible immediately but reduce capital gains later, right, is some of the other ones that I mentioned. And getting the structure and record straight makes a massive, massive difference. So look, if you want to invest in property that's going to make you money and maximize your tax deductions, make sure you talk to us. Give me a call. Make sure you like and subscribe to this video, and or click a link in the description. There's a link to make an appointment to have a chat with me or one of my team. And it's important, whatever you do, if you're in Australia, invest into property, because properties are the ones that can set you up for life and make your retirement a lot more comfortable than if you don't. I've been investing in my property my whole life. I've invested in over 28 properties, as I've said. I've been doing it for over 40 years, and I've never lost my investment property if it's the right type of property to buy, especially properties that have got a positive cash flow where you're making money from it every single week. Don't buy negative geared properties. That's the one thing I'll give you as my experience in over 40 years of investing in property. I'll see you on the other video, and good luck with your investing. Good day. If you're looking to invest in a high income property in the next 3 to 12 months, and whether that's buying an existing property, building a new one from existing plans, or developing land you may already own, then my team and I at Sun Property Institute would love to help you. What we're offering is a free one-on-one strategy session where we'll map out exactly where you are now, right, and where you want to be, and outline the best possible high return and capital growth property options to help you get there faster. Some of the things we'll walk you through is like which property types and strategies are best for income, tax benefits, capital growth, paying your mortgage faster, the best cities, suburbs, areas for future capital growth and returns, and how you can build a property portfolio that could retire you within 10 to 15 years, starting from as little as $70,000 investment. Now, just go to www.Sun Property Institute to book that session, and just click the button on that website to get your free strategy session, or there's a link near this video. If there's a link there, then just click that link. And look at our website. You can also get a copy of a download of some of the books you can see behind me that I have written on property investing, and they're also there on our website. Now, you can take all that information and look, you can run with it and do it all on your own. Or if you like what you see and there is a fit between us, then we can work together with you to help you reach your goals. And either way, you'll learn how to invest smarter with less risk and build your financial freedom with more confidence. So book that call now and book yourself in that session. And either way, best of investing success.